Guys, I'm always looking to find the best stock to buy at any given time. Companies that are both great and trading, most importantly, at the right price. Right now, I'm currently looking at 5 stocks from Joel Greenblatt's Value Investors Club, and I'm going to analyze them today to see if they're selling at the right price. But first, I want to analyze the top stock that YouTube is absolutely in love with right now. That top stock is Palantir. Guys, this stock has absolutely ripped. It's almost at $70 per share. If you remember, 3 years ago, there was a guy, this Russian guy who's in hiding, talking about Palantir stock going to 500. Man, it's on its way. But it was 45 first, went down to 5, and now has gone up to 70. And guys, I said back at 45, I'm like, listen, I'm interested under $5 a share. And it got to like 583. I never pulled the trigger. But guys, guess what? The fundamentals have gotten way better. They have got the free cash flow in this company has gotten way better. But there are some lingering issues I see with the company. Now, $168 billion market cap on revenue of $2.65 billion. It is selling for 63 times sales. That's a lot. Does that mean it's not justified? Not necessarily. If this company could grow its revenue 20, 30, 40% a year for a long period of time, this could end up being a value play because, guys, growth is a part of value. Don't just look at this and think, oh, crappy company because it's selling so expensive. Yeah, if it was going to grow 3 or 4% a year, this is insane. But it's a great balance sheet. $168 billion market cap versus essentially $168 or $165 billion enterprise value. What does that mean? It means they have more cash on hand than debt. That means when you buy the company, you're essentially getting it with no debt, which is phenomenal. And this company has amazing margins. Look at this. 81% gross margin. Every extra dollar they bring in, 81 cents of that is going to go to the bottom line before taxes and overhead. And that's incredible. A company like this can grow their earnings and free cash flow like crazy. There's a lot of major tailwinds helping this company. Guys, look at these financials. Let's look at this income statement. Look at the revenue. 600 million, 740 million, a billion, $1.5 billion, $1.9 billion, 2.23 last year. This year, in the trailing 12 months, 2.65. So not as much as last year, but still amazing growth in this company. Let's go check out their 8 pillars. See how this is looking. Now, here's an issue with Palantir. Got a negative PE and a really high 5-year price of free cash flow. Okay, fine. That I can get away, I can ignore going, hey, you know what? It's a fast-growing business. They're getting it. 5 years is a long time on companies that just started showing profit. I really don't want to look at that. This doesn't bother me. This is what bothers me. 171% increase in shares outstanding. Now, guys, that means it almost tripled. If they had 10 shares before, now they have 27. Major dilution. I don't blame them. Issue the shares out. People love the shares. Give them the shares. But if you're a current investor in the company, you're taking away a big chunk of the growth. Back in 2003, Palantir kicked off its mission with Peter Thiel and Alex Karp and another crew of innovators on a mission to tackle the world's biggest data puzzles, starting with counterterrorism. If you remember back then, 2003, we were just 2 years outside of 9/11. Terrorism was still a big issue. Now, fast forward to 2008, they dropped their game changer, which was Palantir Gotham. That became the go-to platform for government agencies to decode complex intelligence. By 2010, they broke into the private sector, landing JP Morgan as a client and hitting a solid $730 million valuation. But it didn't stop there. In 2016, Palantir took the skies, teaming up with Airbus to save the company hundreds of millions of dollars on its A350 production. And guys, with these companies that build airplanes, that's a lot of money. They also bagged a huge U.S. Army contract after fighting for their spot in the courtroom. By the time 2020 rolled around, Palantir was raking in the big bucks with $100 million plus deals with power players like the CIA and the Department of Defense. Now, remember, Palantir has a great story behind it, but you've got to merge the story with the numbers. There are so many great stories out there of companies, but if you don't believe that there's a price that's too high to pay for a great story, then you're not an investor. You're just a speculator. Because as Professor Oswald says, a story without the numbers is a fairy tale, and numbers without a story is an Excel sheet. You've got to be able to put those two things together. And that's why we use the stock analyzer tool. I sit here and can put in my assumptions about the future, and it'll spit out a price to pay for the company that makes sense based on my desired return. So let's pull up the last time I did Palantir to see what that valuation would have been. I did it just last month. Guys, I did a 10-year analysis. I did 12, 18, and 24% revenue growth per year. Now, it might seem low, but if you do the math on what they're doing right now, this is actually a pretty healthy growth rate. Might be a little aggressive, but I'm okay with that. Profit margin. I went higher. I did 15, 25, and 35% profit margin, and for free cash flow, I did 20, 30, and 40%. They did 42% in the last year. Is it possible that this is too low? Yeah, maybe it is. Now, for PE and price of free cash flow, I'm ignoring what they're currently at. It's useless because you got to pay. This is about the PE and price of free cash flow at the end of year 10, not today. And in 10 years, this company's going to be a lot bigger, and in all likelihood, this growth rate's going to slow. So you got to sit there and put a reasonable PE and price of free cash flow. I did 15, 20, and 25. And finally, guys, I did 9% desired return. You got to remember, when you do your desired return, you've got to see that you've got to get a premium to the market. The 9 or 10% here is basically just the market return. But if you're buying individual stocks, you got to have that margin of safety. How do you get a margin of safety? You put a higher desired return in. That's what's so great here. So we hit the analyze button before we do our next 5 stocks. Guys, we have a low price of 5 to 6, high price of 41 to 47, a middle price of mid to high teens. That's without margin of safety. So for me, the stock's a little too expensive for me right now. Now, guys, in the last 30 days across all of our YouTube channels, we have analyzed over 50 stocks, and our community has analyzed over 1,600 stocks in the last month just on our software. Our community loves this tool. It's used over 1 million times per year. And if you go to everythingmoney.com, you can check it out. And you may have noticed that we have a waiting list there. Today's software includes everything we have to offer, all of the tools we have to offer for retirement, stocks, and real estate. But behind the scenes, we're making some changes. So that offer is going to go away very soon. If you've been following us since day one, I built this software just for myself, that I could and my team could make better decisions and continually help me make suitable investments in stocks and real estates. But as we've grown, it's become less about me and more about how I can better serve you and the community members. And this is exactly why we update our software every single week to give everything you need. Now, the good news is a lot of these changes we're doing behind the scenes have not been made yet. So if you join today, you'll be grandfathered in for life with everything. And this is the best deal we have ever offered. I'm telling you this now because there's still time for you to sign up. As long as you join the Everything Money community before we make the changes, you can keep your plan even after we make the changes, and you will stay in your pricing tier forever. So click on the link in the description below, get access to everything we have to offer, including all these investing tools in the community. I assure you it will be the best investing decision you've made all year, unless you bought Palantir at $5 per share. I'm just kidding. Even that would be a better investment decision. Now, these are the top 5 most written up stocks in Joel Greenblatt's Value Investors Club. Stock number 1, Lululemon. Lululemon is absolutely crushing it right now. In 2023, they raked in a massive $9.6 billion in revenue, 19% more than the year before. They're not just sitting back. With their eyes on the prize, they're pushing it to a colossal $12.5 billion by 2026. And they didn't just grow their bank account. They're expanding their footprint as well. In 2023, they opened 56 new stores, bringing their total to 711 stores across the globe. They even made their debut in Thailand, marking a huge step in their international expansion. This is all part of their game plan to quadruple their international revenue by 2026, but they're not stopping there. Lululemon is also laser focused on doubling its e-commerce revenue by 2026. they're blending the best of both worlds with a strategy that combines seamless online shopping and top-notch in-store experiences to give you the ultimate shopping vibe. But again, is this a good story that is overpriced? Well, let's pull up our stock analyzer tool and see what we did on Lululemon in the past. 10-year analysis, guys, 5, 8, and 11% revenue growth. This might be low if they're going to double their international sales in the next 2 years and increase their revenue another 25% from today over the next 2 years. Profit margin, I did 14, 15, and 16%. Free cash flow, I went a little bit lower because of 10 years, but I probably should increase this because it looks like free cash flow is catching up nicely. Now, PE and price to free cash flow, I did 15, 17, and 19. Even with a growing ROIC, it might be a little low. I probably should go higher and have a higher margin of safety. So I'm going to go 15, 19, and 23. I'm going to be a little more aggressive, but again, doing my 9% return, you need a higher margin of safety. Hit the analyze button. I got a low price of 200, high price of 480, middle price of 311. Again, this is based on you can analyze this yourself and decide what makes more sense for you. Stock number 2, Skechers. Guys, another retail play right here. Skechers smashed in 2023. They raked in $8 billion in revenue, jumping 16.4% from the year before. And the real kicker, pun intended, their direct consumer sales shot up a wild 24%. But that's not all. Skechers went on a store opening spree, launching 1,144 new locations globally, bringing their total to almost 5,200 stores. Regions like Europe, the Middle East, and Africa are popping, with stores growing 49%. And of course, they didn't forget their online game, seeing a 19.6% increase in e-commerce sales as part of their plan to crush it both in-store and online. And guys, remember, when they do it online, they don't have to worry about the markup to other stores like Foot Locker or Champs or wherever they're selling to at a wholesale price. So what's the stock analyzer on Skechers? I don't know if I've ever done Skechers. Let's see if I have. I never have, so I'm popping my cherry right here. So I need some guidance here. So I'm going to look at analyst estimates on the revenue growth side. Looking like double-digit growth here, but slowing. So let's go to stock analyzer. For 10 years, I'm going to do 4, 7.5, and 11% revenue growth. Profit margin, yeah, it's increasing, but still low. And one thing I like is that their free cash flow in the last year has caught up to their profit margin, even though in previous years it was not. So I'm going to sit here and I'm going to do 6, 7.5, and 9%. For PE, you know, the PE here is tough. Skechers, look at their ROIC, not the best, declining. So maybe we do something like 13, 15, and 17. And again, our 9% desired return, hit the analyze button. The stock is currently at $68 per share. Oh, interesting. $52 on the low side, $155 on the high, $91 in the middle. Maybe this is why this is getting the attention of the Value Investors Club. Guys, stock number 3, if you're comparing Skechers, you got to look at Crocs, which was a very, very big Value Investors Club stock. Now, Crocs made an acquisition of Hey Dude. They're trying to grow their market and try to expand their product line. Guys, I thought Crocs was a fad. Maybe it's not. I see them everywhere, and they're so practical for so many different things. Are they attractive? Beauty is in the eye of the beholder. Their whole giblets, they look kind of cool. I get why people like them. People in my family like them. The females tend to make fun of them. The guys who wear them, I don't wear any myself, but I see the practicality in them. Our good friend on the channel, Mo, he loves his Crocs. But again, this is a company that has seen some up and downs. What's interesting about them, though, is look at their price to free cash flow, 5.6 and 7.8. Look at their return on invested capital, 18% and 19% over the last 5 years. That's pretty incredible. Now, their Hey Dude portion is slowing, but it doesn't mean the company itself is slowing. In fact, look at analyst growth estimates. I'm actually surprised by this. 3%, 3%, 4%, 17%, 7%. So, is this the start of something bad for Crocs? I don't know. But somebody in the Value Investor Club seems to see a lot of value in this. So let's go see what our last valuation of Crocs were. Now, I went a little more conservative. I did 0, 3, and 6% revenue growth. I did profit margin of 17, 20, and 23. Same with free cash flow. PE and price of free cash flow, I did 13, 16, and 19, and 9% across the board for margin of safety, my desired return. Guys, I think you need a higher margin of safety for this. This company is one of those that could, is it a fad or is it going to continue growing? I don't know. But hit the analyze button. The stock's at 110. This is why it's interesting to people. A low price of 133, high price of 350, middle price of 218. So guys, here is what I'll say about Crocs. If Crocs is going to be around for the rest of the time and they're going to grow even at 4 or 5% a year, this is a no-brainer, right? Because you look at this going, I made my assumptions on 3% here in the middle. The other thing is, look at their balance sheet. They're easily handling this balance sheet difference of debt here. Let's look at their 8 pillars, an 8-pillar thriller. So that's what's interesting about these companies. You can find great numbers. The question is the market perceiving this to be a fad, or do you know something better? Because if this isn't a fad, this could be a very great buy right now. But for me, I like to invest in companies that I think are very, very high likelihood to be around for decades to come. I'm going to make less return for that because it's more of a sure thing versus something like Crocs, but that's why the upside potential in Crocs is so big. Stock number 4, Match Group. Guys, they're also on fire with Q4 revenue of 2023 jumping 10% year over year to $866 million, fueled by massive gains from Tinder and Hinge. Tinder brought in $494 million, up 11%, while Hinge skyrocketed 50% to $116 million in revenue. The company's revenue per pair, RPP, surged 17%, hitting $18.67, with the biggest growth seen in Americas and Europe. On top of that, Match Group has been crushing it on the cost side, boosting adjusted operating revenue by 27% and expanding its operating margin to a solid 42%. They're also sitting pretty with almost $900 million in cash, proving that they're in great financial shape as they continue to grow and expand. And don't forget, guys, where's the expansion worldwide? How many people in poor countries are using these apps? 0. Imagine that growth as they expand internationally. That's what's incredible. So let's pull up a stock analyzer as we see this company go from an all-time high of 182 about 3 years ago to a low recently of $27 per share back in May. That's a big, big drop. Is it justified? Well, that's the question we have to ask ourselves. So let's look at Match Group. I did it about 6 weeks ago. I did 3, 6, and 9% revenue growth. I did profit margin of 10, 14, and 18. Guys, look at this free cash flow. Way higher than their profit margin. I did 22, 25, and 28. Even though the last 5 years, they did 39% gross free cash flow margin. So I'm probably being too conservative here. But I don't like seeing this inconsistency here. That's what kind of worries me. But I haven't done a deep dive into it. That's where your advantage as a person who understands Match could be better. 15, 18, and 21 on the PE and price of free cash flow, and 9% desired return. Hit the analyze button. Boom. This is why it's interesting. Focusing on free cash flow, 43 on the low side, 106 on the high side. It's currently at $33 per share. Is this worth it? This middle 19.5% potential return could be interesting. Stock number 5, Axcelis Technologies. Guys, this company hit a high of $201 per share about 15 months ago. It is now at $76 per share. These guys are part of the semiconductor game. They're in that area. They're crushing it in the semiconductor space, posting an impressive $1.13 billion in revenue for 2023, which is a solid 22.9% jump from the previous year. This growth is driven by surging demand for its Purion product line, which continues to dominate the ion implant equipment market. But they're not slowing down. They're making smart investments in their future with a strong cash reserve of $870 million and a focus on research and development and cost-efficient production strategies to keep the momentum going. With these solid growth numbers, the market leadership, and the forward-looking financial strategy, Axcelis is well-positioned to keep delivering strong returns in the semiconductor industry as this industry continues to expand and grow. Now, guys, I made my assumptions here. Now, the semiconductor industry has surged and it's coming back down, but you have to ask the question, what does the next 10 years look like, especially for a company that's trying to lead the market? So I did 3, 6, and 9% revenue growth. Okay, way below their last 10-year growth of 18.38% per year. Profit margin, I went lower because they crushed it in the last few years. So I'm assuming a little bit worse. I did 13, 16, and 19% for profit margin and free cash flow. For the PE, okay, their ROIC is not insanely high, but it's higher than normal. So I did 15, 18, and 21. And I did a 9% desired return. I hit the analyze button. Boom. I have a low price of 65, high price of 187, middle price of 113. Guys, if you want to see 3 undervalued stocks that I'm looking at, watch this next video. Thank you for your time.